The insurance industry is watching as the story of the coronavirus evolves. Joining us now is George Hansen, Senior Research Analyst, and Burno Caron, Senior Financial Analyst, both with AM Best. Thank you for speaking with us today. George, can we start with you? How do life insurers manage pandemic risk?
Life and health insurers manage pandemic risk primarily through stress testing. These stress tests involve shocks to mortality, morbidity that last a fairly short period of time before grading back to the normal assumptions. Another area that insurers might overlook is the impact on the GDP. The Spanish flu, for instance, is estimated to have cost the GDP 4.25%. So companies that have economic capital models are in good position to model those kind of events that go along with the increased mortality and morbidity risks. A further stress test that companies can look at is reinsurance. There's a potential for disruptions in reinsurance with a high volume of claims that could be a result of a pandemic. So there are a lot of things other than just the mortality and morbidity risks that companies can use to test or manage the pandemic risks.
Burno, how is pandemic risk captured within the AM Best methodology?
Well, pandemic risk is captured within all four building blocks. To begin with the balance sheet, to George's point earlier, reinsurance is a major aspect of pandemic, but also multiple other factors such as liquidity, fungibility, strength of reserves, quality of capital. All of these aspects that we look at in terms of qualitative and both quantitative are very important. And under a pandemic scenario, those mechanisms could be put to test. So, of course, the absolute level of capital and the risk-adjusted level of capital are also extremely important. Going on the operating performance, the diversity of earnings could also help as well. And that gets into the business profile with concentration issues. Concentration issues are obviously a very predominant factor for property and casualty companies. So for life companies, under pandemic stress, that would be one place where that could come into play. Last and not least, enterprise risk management. Again, to George's point, stress tests and the identification of the actual risk, the quantification of the actual risk within the risk appetite and risk tolerances. Those particular stresses get the conversation going in terms of leading back to our first two building blocks, the capital that is required, as well as the earnings that are at risk.
So, George, do you see this as more of a reinsurance event or a primary insurance event?
Well, reinsurers may have a totally different risk profile from ordinary life insurers. Ordinary life insurance, when we look at it, the composite industry, mortality and morbidity risk, it's very low. It's somewhere down in like 5% of the required capital. When we look at reinsurers, the mortality morbidity risk profile, it may be 40 to 50% of their required capital. So yeah, depending on their risk profile, they may be at much higher risk in the event of a pandemic. And it's for this reason that we've seen reinsurers diversify their risks over the last several years. Reinsurers are now involved in financial solutions for companies. They're taking on other types of risks so that they're not primarily focused just on mortality and morbidity risks.
So, Burno, how could pandemic risk impact the stability of the life insurance industry?
Well, it is always possible to create a scenario where life and health industry would be under severe pressure. However, we continue to believe that the life and health insurance industry is well capitalized, which is probably the main defense mechanism that the industry has. So while there is multiple data points that are available within history, it's important to understand that it's a major unknown. Modeling gets the conversation going, but at the end of the day, capital is the key aspect for the life and health companies to protect themselves against that type of risk.
And I'll add that one of the primary challenges for insurance companies is enterprise risk management, and this is the purpose of enterprise risk management, looking at things above and beyond the normal course of business. And so companies that are able to function properly in the event of these events will be in much better shape. One exercise that companies are asked to do now from the New York perspective is identify what percentage of your workers could telecommute, for example, and deal with a situation like this, and for how long. So it's really coming down more to enterprise risk management practices to identify these risks.
George and Bruno, thank you so much for speaking with us today.
Thank you.
Thank you.
For AM Best TV, I'm Meg Green.